0 baht. That is the Thai personal income tax bill. A 68-year-old US government retiree remitting 960,000 baht per year to Thailand can legally owe. Not through offshore tricks, not through aggressive planning, but by understanding a single article in a treaty most expats have never read. And sitting in the same condo building, same Chiang Mai neighborhood, is another American retiree. Same age, same remittance amount, same days in Thailand, who may owe the Revenue Department up to 188,500 baht this year. The only difference between them is what type of pension they receive. One word in a tax treaty. That is the entire gap. This video is about how Thailand's personal income tax system actually works in 2026. The brackets, the deductions, the deadlines, and the legal shelters that most expats either don't know exist or assume don't apply to them. Let's start with why this matters right now, and why the stakes are higher in 2026 than they've ever been. In January 2024, the Thai Revenue Department issued two orders, Port 161 and Port 162, that permanently closed what expats used to call the prior year lag loophole. Before 2024, if you earned money abroad in one calendar year and remitted it to Thailand in the following year, that income was not assessable. It was a quiet workaround that thousands of expats had relied on for years. That rule is gone. Since the 1st of January 2024, every baht you remit to Thailand is assessable income in the year you send it. Full stop. The 2025 tax year return, covering everything you remitted during calendar year 2025, is due on the 31st of March 2026 for paper filers, or the 8th of April 2026 if you file online. That 8-day extension is one of the numbers most expats don't know exists. The penalty for non-filing is 200% of the tax owed, plus 1.5% monthly interest. Not 20%, 200. If you owe 100,000 baht and you don't file, the penalty alone is 200,000 baht, before interest. Here's what makes this personal. If you earn the equivalent of $5,000 per month from abroad and remit it all to Thailand, that's roughly 175,000 baht per month at current exchange rates, 2.1 million baht per year. Under the new rules, that entire amount is potentially assessable. Before deductions, before treaties, before any planning, you are sitting in the 25 to 30% tax bracket on a significant portion of that income. That is a real number. It deserves your attention. Before we get to brackets and deductions, we need to answer the threshold question. Are you a Thai tax resident at all? The rule is straightforward. If you spend 180 days or more in Thailand during a calendar year, that's any 180 days, not necessarily consecutive, you are a Thai tax resident for that year. No visa category changes this. Not the DTV. Not the LTR if you're outside its specific tax exemption structure. Not a retirement visa. The day count is the only test. 180 days. If you're over that line, you're in the system. Under it, and Thai PIT doesn't apply to your foreign income at all. And if you're a tax resident with assessable income above 120,000 baht for the year, you are legally required to file a return, regardless of whether you owe any actual tax. Filing and owing are two different things. Here are the 8 brackets. Thailand's personal income tax is progressive, meaning you only pay the higher rate on the slice of income that sits in that band, not on everything below it. 0% on the first 150,000 baht, 5% on the next 150,000, 10% on the band from 300,000 to 500,000, 15, 20, 25, 30. The rates climb as income rises. And the top rate of 35% only kicks in on net income above 5 million baht. That 35% number is the one that triggers anxiety in expat Facebook groups. But here's the context that matters. 5 million baht net means after every deduction, every allowance, every treaty exemption you're entitled to has already been subtracted. A single individual would need to remit more than 5 million baht of fully assessable, treaty unprotected, deduction exhausted income to reach that bracket. For the vast majority of retirees and digital nomads in Thailand, that threshold is academic. The number that actually governs most expat tax bills is not 35. It's the net taxable income figure after you've taken every deduction the system legally allows. Let's walk through what you can actually subtract before a single baht of tax is calculated. Every tax resident gets a personal allowance of 60,000 baht. If you have a spouse who is also a tax resident with no income of their own, add another 60,000. If you're aged 65 or older, you get an additional elderly allowance of 190,000 baht. That's 310,000 baht gone before we've touched anything else. Life insurance premiums paid to Thai insurers are deductible up to 100,000 baht per year. Health insurance, including international health plans registered with Thai insurers, up to 25,000 baht. A pension-type life insurance policy adds another 200,000 baht of deductible space. Run those numbers for a 65-plus retiree with a spouse, standard insurance costs, and no exotic planning, and you're looking at 480,000 to 600,000 baht of gross remitted income that generates zero Thai tax, before a single double tax agreement benefit is even applied. That is not a loophole. That is the Thai tax code doing exactly what it was designed to do. 61. That's how many countries have a double tax agreement with Thailand. The US, the UK, Australia, Germany, France, the Netherlands, Canada. Almost every country where Western expats originate has a treaty in place. These treaties are not vague aspirational documents. They assign taxing rights to specific income types with legal precision. And for many expats, they are the most powerful tool in the entire Thai tax system. Go back to our 2 American retirees. The civil service pensioner benefits from Article 19 of the Thailand-USA Double Tax Agreement, the Government Service Article. Under this provision, pension income paid by the U.S. government to a U.S. resident for services rendered to the U.S. government is taxable only in the United States. Thailand cannot touch it. The Thai tax liability on that income is zero, permanently, regardless of how much is remitted or for how many years. The private sector retiree drawing from a 401k distribution has no equivalent protection. That income falls under Article 20 of the same treaty, and Thailand's taxing rights apply. The same logic applies across treaty types. UK state pension, German government pension, Australian government superannuation. Each treaty article is different. The work is in reading the specific treaty that applies to your income source and your nationality. That is not something to guess at. Here is what the expats who've navigated this correctly are doing differently. First, they've separated their income by type before remitting. Salary income, pension income, investment returns, rental income from abroad, each has a different treaty treatment and a different deduction profile. Mixing them into a single monthly transfer and calling it living expenses makes it harder to argue treaty protection at the point of a Revenue Department audit. Second, their filing. Even when they believe their net tax owed is zero. Filing a return with a 0 baht liability, supported by treaty citations and deduction calculations, is the documented proof that you engaged with the system correctly. Not filing because you think you don't owe anything is a different posture entirely, and a riskier one. Third, they know their DTA. Not in general terms, article by article, for their specific nationality and income type. A 45-minute conversation with a Thai tax advisor who specializes in expat cases costs a fraction of what a 200% penalty surcharge costs. The online filing portal at the Thai Revenue Department's website is functional and in English for the core forms. The e-filing deadline of 8 April gives you 8 additional days over the paper deadline. Use them. One thing to take from this: your Thai tax bracket is not determined by how much you remit. It's determined by your net taxable income after every deduction and every treaty exemption you're legally entitled to claim. Most expats calculate their exposure using the gross remittance number and panic. The correct calculation starts from the gross and works down. And for a large portion of the expat population, it lands at a number that is far lower than the fear suggests, or at zero. The gap between a large tax bill and a 0 baht bill is not about where you bank, what visa you hold, or how long you've been in Thailand. It is about knowing 8 brackets, your deduction stack, and 1 article in a treaty. For the full deduction calculator, DTA country-by-country breakdown, and filing deadline tracker, subscribe to the Bangkok Brief newsletter at thebangkokbrief.com. Or subscribe to this channel so you don't miss what comes next.